These people aren't on a podcast telling people to buy gold.
Do you see a higher probability of gold being revalued and the Treasury sell-off in July?
Silver is down 11%. Gold is down 6%. They're ahead of us. They're people who understand what gold represents, and therefore they have to penalize them for owning gold. And at the same time, you're seeing the COMEX react to the lack of open interest by completely slashing margins down by 6%. Prepare for the worst, best you possibly can.
And what would be the likely way that gold becomes hard to find for swapping when the gold-silver ratio goes down to 40 or lower?
Just what that guy said. If you own gold as someone like owns a metal company or speaking online, holding it at home is silly, probably.
Yeah. How do you see the Mexican government closing silver mines as they are one of the biggest producers? Without these producers, should prices not be going up?
With all the metal leave the LBMA, all the metal leave the New York Fed, whoever's taking metal out of COMEX, it's removal of counterparty risk.
Is China still buying on a record amount of silver?
Articles that Goldman Sachs said is that their numbers just aren't adding up. The Chinese numbers are way higher than what they...
Do you see a higher probability of gold being revalued? What did you say the DT was? Despite the Treasury sell-off in July. I mean, this is the question. A
lot of people think he will revalue it. I don't know that he'll revalue it all at once like this. I don't know. I mean, they got the new $250 bill coming out. You saw that it's gold colored.
Yeah.
I don't know if he's going to. Maybe they'll revalue it to the mark-to-market price.
Yeah,
it should be just the actual price before they revalue it to a much higher level. And Nixon did it 2 years in a row. When gold closed in 71 at $35, he revalued it to 38 in 72 and to 42.22 in 73. Both times devaluing the dollar. So could it happen more than once? Sure. At the very least, it should be marked to its market price.
Yeah, I was watching. I go to sleep to YouTube every night, watching all the various things. Of course, the other night was Mario Necco. And he was talking about the revaluation.
So basically, you're saying Mario puts you to sleep?
No. Actually, I was watching Michelle McCoy, and thank you, Michelle. You were beautiful, and everything was spot on as always. And then Mario came on because he's usually 6 hours ahead of us, and I don't sleep, so I catch him right away when he launches it. And he was talking about the revaluation, talking about the amount that the United States can add to their balance sheet if they, and all the various different levels of mark to market, whether it was current spot 4,500, and then of course if we went to 7,000, 12,000, even 24,000, how different the United States balance sheet would look.
The US officially values its gold one way, while markets value it another, and that contradiction keeps getting harder to ignore. Andy Schectman notes that even a partial mark-to-market adjustment could dramatically alter how federal balance sheets appear without producing a single new ounce of gold. The overlooked issue isn't the price target itself. It's why policymakers might suddenly need a stronger asset backing deteriorating fiscal optics. For savers, revaluation discussions signal stress inside the monetary framework, not prosperity. Next, Andy Schectman exposes why balance sheet repair may require admitting the dollar has already been quietly devalued.
Not only that, every $4,000 increase gives the Treasury general account $1 trillion free and clear.
Correct. So we would basically be going from a $39 trillion deficit to, at least on the books, down. We'd be cutting it down. I think he said it was roughly around 7 to 8 trillion if we revalued it at that 24,000. Yeah, which is, I don't think that we would. I mean, look, who knows? Who knows? But that would be that would be life-changing for a whole lot of people. But it would also mean a lot of other things to a lot more people.
I can't even imagine what it would look like. But who's to say? I mean, look, there is no question that Trump is taking the steps to, if he is trying to bring back manufacturing, if he is trying to, have the epicenter of energy here in North America instead of in the Middle East, if he's trying to do all of these things, bring back mining, to give us really what we would need to, in an environment where things are moving rapidly in AI and changing the employment landscape. These are very important things, and he couldn't tell everyone until it's already in place. If he is doing this stuff, God bless him. I mean, He will go down as certainly being a polarizing figure, but if he really did all of this stuff, he would be the best president of all time because of what it would mean to future generations.
Yeah.
And I guess the jury is still
out. We'll see. Time will tell, that's for sure.
A government drowning in debt suddenly benefits from a much higher gold price, and that incentive deserves more scrutiny than it gets. According to Andy Schectman, every major jump in gold's valuation could materially improve Treasury accounting metrics on paper. That's where the narrative becomes uncomfortable. Are policymakers solving structural debt problems, or merely changing the denominator investors focus on? For retirement savers, accounting improvements don't automatically translate into stronger purchasing power. Next, Andy Schectman reveals why debt reduction headlines could mask a deeper shift in the value of money itself.
India just added a new 100-gram contract to 100-gram gold contract to what they're doing. So you're beginning to see this move all the way down to greater utility with jewelers and craftsmen and that kind of stuff. All of these things chip away at the COMEX and at the Western system as price discovery is moving in that direction. You've seen these export numbers that are still pretty high here in the U.S. as the traders are chasing the $85 gold premium. They're chasing the 8, 9, 10, 11% or more silver premium. Actually, it's actually 12 or 13%. And it's substantial. You deliver 10 million ounces at $11 premium, you make $110 million. That's why you're seeing so much of this flow to Asia. They are systematically siphoning off everything by using this arbitrage. It should have been gone months ago.
Yeah, and then of course I listened to something that was on mainstream, and it was literally just a blip, and I caught it, and it talked about India raising tariffs from 6 to 15%, and nothing else. It was just basically like they raised tariffs, so they raised their import fees X, Y, and Z. And I started researching it and looking as to why would they do it, and it was really more about their currency.
Yeah,
it's supporting the
currency.
Yeah, support the rupee.
Currency.
And they're trying to reduce the account deficit that they have.
See, they're ahead of us. Their people understand what gold represents, and therefore they have to penalize them for owning gold. And at the same time, you're seeing the COMEX react to the lack of open interest by completely slashing margins down by what did they do? By 6%. Let's see, silver is down 11%. Gold is down 6%.
The West says gold is just another commodity, yet entire nations keep restructuring policy around it, and that contradiction matters. What Andy Schectman is highlighting is that India isn't merely expanding gold access, it's integrating gold deeper into everyday commerce while simultaneously managing currency pressures through tariffs. Meanwhile, COMEX margin reductions suggest an exchange trying to revive participation rather than one overflowing with speculative demand. For wealth preservation investors, the signal isn't price alone. It's where physical metal keeps migrating. Next, Andy Schectman exposes why shrinking Western participation may be accelerating the shift in global price discovery.
They've slashed the margins to get people back in, to get the interest back in. It's a sign of desperation. At the opposite end of the spectrum is India, that everyone is buying it to leave the currency that's weak.
Correct.
That should be happening here, but the people here don't get it.
Yeah, well, I mean, that was basically what you just said was the rationale behind it.
Right.
So, and then what you were talking about with losing faith and is the Hong Kong basically setting up this new global gold hub, which I'm sure you know certainly a lot more than me about it. It's this new gold hub that they're trying to build. Basically, it says that the largest place for buying and selling gold is London, New York, and Switzerland, and China is now making Hong Kong a much bigger and more important place for gold trading.
They're building in Hong Kong, Saudi Arabia, UAE, and Switzerland. Yeah. They are trying to mimic and beat the West at their own game.
And basically it's a government-owned clearing system that's going to reportedly mirror the LBMA. And basically it's like a big scoreboard that helps them keep track of who owns gold, who's buying gold, who's selling gold.
This is the easiest way, I think, for people to think about this. We're supposed to believe that rising yields are putting pressure on gold and silver. But the other side of the world, they look at it completely opposite. They see rising yields as an indictment to the dollar system. Therefore, they're dumping treasuries, which pushes those yields up higher, moving into gold and silver, which are beating the performance of the treasury without that counterparty yield. And so it's weird. We look at it one way, they look at it the opposite way. And the mainstream will say, well, rising real yields, people will buy treasuries. Yet the foreigners say, well, the nuts to that, I'd rather buy gold. The rising yields signal the rot from within inside the whole system.
Yeah, well, I think that this is definitely a sign with China that they want to have a lot more control, more influence over the gold market, instead of letting London and New York dominate virtually everything the way it has been forever for the most part.
This happened before major monetary transitions. Financial power shifted geographically long before headlines admitted it. Andy Schectman's argument suggests Hong Kong's emerging gold infrastructure isn't simply about efficiency. It's about building an alternative center of gravity outside the traditional London-New York framework. The deeper contradiction is that Western analysts often treat rising yields as bearish for gold, while many foreign buyers interpret those same yields as evidence of systemic strain. For investors, understanding which interpretation wins could determine future portfolio performance. Next, Andy Schectman reveals why global gold flows increasingly contradict the narrative driving markets.
You talk about this all the time. Hey guys, what happens to all the dollars in accounts once there is a new money and traditional system? How does gold play out? So we talk about it all the time.
It would just be repegged, I guess. So, it's...
well, it's like you said, that you wake up one day and instead of it being in your bank account, it's all just digitized.
Well, you won't notice a difference.
Right. That's what
I mean, it'll still be in your bank. It'll just move much faster.
Yeah.
And that's coming.
And they'll be able to know exactly what you're doing, when you're doing it, how you're doing it with virtually every single penny.
You saw they came out, I think it was Besant who said, these folks in Iran opened up their wallets and they everything was gone and they had no idea. That's Tether. Tether has the ability to stop. That's one of the things that Captain Awesome Fitz really doesn't like about the stable coins is that they're programmable. So not only do they know who you are, KYC, KYT, what you're buying, know your transaction, and AML, where you got your money, anti-money laundering, they will be able to identify you to stop. And as they said, what they did to the wallets that were tied to the IRGC, they froze them at the smart contract level. So even if they were able to pull them out of the wallet, they could not be used anywhere. They were locked and frozen. And it's scary when you think about, the Orwellian type of consequences that a bad guy like you could run into.
I'm telling you. All right, here we go. Kevin Chesney, great name. 2426. Hey guys, great job. What do you think of BIX saying, quote, only hold physical metal because mining stocks are based on the dollar and the dollar is going to nothing? I don't know what to think.
I mean, I'll tell you, there are very few people I've met that are more authentic than him.
The biggest financial risk may not be inflation. It may be discovering your assets are programmable when you need them most. What Andy Schectman is highlighting is the growing distinction between owning value and merely having access to it through digital systems. The public conversation focuses on convenience, yet institutions continue expanding surveillance, compliance, and transaction control capabilities behind the scenes. Investors protecting generational wealth should pay attention to who ultimately controls settlement and permissions. Next, Andy Schectman unravels why ownership and access may become two very different concepts in the next monetary system.
I know him as a friend outside of this. I traveled with he and his wife in his Winnebago from Texas to Oklahoma. He blew my mind on a lot of stuff. He's very well read. He's very smart. He's opinionated and he's different. I think his take is fresh. I think the way that you're supposed to do this stuff is listen to everyone, listen to all this stuff and formulate your own opinion based upon what you took in.
And trust your gut.
Trust your gut.
Gut's almost
But he's
wrong.
a smart dude. And what he is basically saying is one of the things you're seeing with all the metal leave the LBMA, all the metal leave the New York Fed, and whoever's taking metal out of COMEX, it's removal of counterparty risk. There is a lot to be said for that. And I will tell you, he's completely authentic. So I think you take it for what it is and add it to the other things that you have that you've been reading and listening to and make up your own opinion. Because really, peace of mind and sleep at night is the best asset you can own.
Which, I agree 1,000% with what you said. Everything you just said. I just think that there are certain circumstances that are somewhat out of your control. Somebody who has a lofty IRA and they want to be in metals because they no longer trust the equities market or the dollar, what are they to do? Well, I mean, if you're a 52-year-old guy or gal and you want to take the money out, you're now looking at a 10% penalty, full tax on the distribution that you take out.
Well, that's the old statement, hope for the best.
Markets celebrate paper claims, while large quantities of physical metal keep quietly leaving major vaulting systems. Andy Schectman's argument suggests investors should focus less on price volatility and more on the steady reduction of counterparty exposure by sophisticated participants. If confidence in custodians and exchanges were truly rising, why is so much metal migrating into direct ownership structures? For those nearing retirement, that question matters more than the daily spot price. Next, Andy Schectman reveals the contradiction between bullish paper market confidence and physical market behavior.
Prepare for the worst, best you possibly can. You do what you can within the confines that you're thrust into, I guess.
But you do what you can. I mean, look, it's great to have all your metal on you. But I mean, Andy and I told you last week, we went and we made a deposit into Brinks, and you know what? I still have plenty here, but I felt great.
Well, these people aren't on a podcast telling people to buy gold.
Yeah,
it's better if you own gold as someone like owns a metal company or speaking online. Holding it at home is silly, probably.
Yeah, I mean, we live.
Most people don't tell people, right?
Without a doubt. Yeah. All right.
Loose lips sink ships.
That is true. I'm all gone. I'm all out. I have nothing. No silver, no gold. We're leaving it at your house.
Okay.
Yeah. All right. Anonymous Abe. Question: what would be the likely way that gold becomes hard to find for swapping when the gold-silver ratio goes down to 40 or lower?
Just what that guy said. I mean, you get that's the one potential fly in the ointment with the silver to gold swap. It is. And it's not something, I mean, I've seen it repetitively over 35 years in far more mundane atmospheres. And it had less to do with public interest as it did mint inefficiency. So that would be it. It would be that, there's a delay on getting stuff because everyone's running through the same revolving door at the same time.
Yeah. And the thing that would probably happen.
Supply shortages rarely begin when everyone panics. They begin when demand quietly exceeds a system designed for normal conditions. This is where Andy Schectman's thesis shifts from price speculation to logistics reality. Historical bottlenecks in precious metals often emerged not because metal disappeared, but because fabrication, minting, and distribution couldn't keep pace with demand surges. Investors waiting for perfect timing may discover availability becomes the real premium. Next, Andy Schectman exposes why the next precious metal squeeze may start in supply chains long before headlines acknowledge it.
Would almost happen at the same time is you'll get people swapping silver for gold, and then you'll get the people that are now starting to awaken that have never been in the metals before at the same time. So if you get that simultaneously, it's going to be tough.
That's the old layer theory that we've talked about, where you start peeling it as it gets into the upper 40s, low 50s.
And that way you're not, you don't have to worry necessarily. You'll at least always have something.
Bix would say, why the hell would you do that? Keep your silver.
Of course you would.
Go 1-to-1.
100%. I don't know that we're ever going to see 1-to-1. I mean, we might. Listen, I always say, you can't get to 300 without getting to 100. You can't get to a 1-to-1 ratio or a 7-to-1 ratio before you get to a 40-to-1 ratio.
Well, I think a lot of it's going to come with the Western system really just losing their ability to price things realistically. You're going to see it move to the east, and then we'll see what real price discovery is.
Yep. How do you see the Mexican government closing silver mines, as they are one of the biggest producers? Without these producers, should prices not be going up?
Well, if Mexico did, I would suspect you'd see Peru do it right after that. And as they should, every country for themselves. Mexico's a poor country, and if they focused on their infrastructure and their natural resources for their own good, maybe it'd be to their benefit. I've always thought it was silly that even the mining, the geopolitical and the geographic risk associated with mining, but I also think it's silly for countries like Australia, the UK, and South Africa and Austria to send us their their finished product.
Markets still price silver, as if supply chains are permanent, open, and politically neutral. But history says otherwise. As Andy Schectman points out here, a rush of silver to gold conversions combined with first-time buyers could overwhelm available inventory long before price charts reflect the stress. The deeper issue is that major producing nations increasingly have incentives to retain strategic resources rather than export them cheaply. For investors, the risk isn't simply missing higher prices, it's discovering that desired products are no longer readily available. Next, Andy Schectman exposes why resource nationalism could reshape precious metals pricing faster than most analysts expect.
Their coins instead of, I remember when it was very difficult during the pandemic to get eagles, and it was easier for me to get kangaroos from the Perth Mint. And I was talking to people in Australia who were saying that the Perth Mint didn't have anything for their own people. So there's going to come a point perhaps where it's just, closing the hatch and say no more shipping to the West, and we're just going to focus on our own self-interest. I'm surprised that hasn't happened. Maybe we'll see that. These are the things that the potential pitfalls of that swap.
Yeah, no doubt. Coindom65 says, is China still buying on a record amount of silver? Yeah, I believe they are.
I think
continuing. You have the numbers?
Let me see if I have some numbers.
Nope.
I thought I did. Let me see. I might. Well,
what happened here?
I don't have the recent numbers for China, but I have no reason to believe that it's stopping whatsoever. I mean, it's been going on for the last couple of months, the entire first quarter.
Nobody's talking about export restrictions, but they could matter more than the next Fed meeting. Andy Schectman notes that during prior shortages, availability problems appeared regionally before they showed up globally, creating the illusion that supply remained healthy. The mainstream assumption is that metal will always flow to the highest bidder, yet governments increasingly prioritize domestic stability over free market efficiency. Investors focused only on spot prices may miss the growing importance of access and jurisdiction. Next, Andy Schectman reveals why physical availability could become disconnected from quoted market supply.
My guess is that yes, they are. I'll have those for next week when we do it.
Are you going to be here next week? When did you get back?
No. Yeah.
So yeah, unless we do it on Tuesday,
which we could
do it on Tuesday.
But I'll have those numbers. Oh my goodness.
Yeah, I don't know if they're going to be doing the podcast.
I come home to her parents.
I would actually like to do the podcast with your dad.
No, probably.
That'll be fun. All right.
But here's the thing. My guess is 100% yes, because you're still seeing that the price that is almost $10 higher than the Western price.
Yeah.
So yes, they're still siphoning. I'll have those numbers for you. But
and I'm sure whatever numbers that we're hearing, you can assume they're quite a bit larger than what we're actually hearing about. So that's what I would tell you. All right, let's see. That's Jason Cousins.
It's funny, that's one of the articles that Goldman Sachs said, is that their numbers just aren't adding up. The Chinese numbers are way higher than what they
originally. We talked about that last week.
Markets went up, but the pricing gap between East and West remains stubbornly elevated, and that divergence deserves attention. According to Andy Schectman, Chinese demand appears stronger than official reporting suggests, with regional premiums continuing to signal aggressive accumulation. When physical metal consistently commands higher prices in one region, it raises questions about where true demand is actually concentrated. For long-term savers, the danger is relying on public data that may lag reality by months or years.